Hello and welcome to Donation Investment. This analysis is for Eli Lilly on the New York Stock Exchange as of 7th of August 2026 with a share price of $1,191. The full report is on donation.ca. A hold at $1,191.94. Eli Lilly is one of the best franchises in large-cap pharma, the branded leader of the obesity and diabetes supercycle, and second quarter results were a clear beat and raise. But the shares rose about 7% on the print and outran the guidance raise, so at roughly 33 times forward earnings, the valuation ceiling gate still caps all three horizons at hold. A great business, but the price has moved ahead of it. Start with what is genuinely rare. Lilly scores 85 on quality, with return on invested capital in the 92nd percentile of its peers and a research engine that ranks near the top of the industry. The second quarter confirmed the ramp. Revenue grew 48% year-on-year, Mounjaro rose 91% to $9.9 billion, and US Zepbound was up 44%. Lilly is taking share in a duopoly that controls about 87% of prescription weight management revenue, and it holds a first-mover lead in the oral version through orforglipron. The patent estate is unusually long-dated. This is a compounder, not a coaster. Here is why a beat and raise did not make it a buy. Valuation scores just 37. Lilly lifted its guide, but the shares rose about 7% on the print, faster than the earnings raise, so the clean forward multiple is now about 33 times, against a warranted 22 times. That is a ratio of 1.50, which the framework reads as expensive and double confirms against the sector floor. It is marginally more expensive than before the print, not cheaper. That is the valuation ceiling gate, and it caps all three horizons at hold. Free cash flow yield is about 1%. You are paying a full premium for a superb business. The print flipped the tape. Timing rose from 53 to 64, with every time frame now pointing up and price back above the 50-day average, so confluence is strongly bullish, where a week ago it was rolling over. The earnings event risk gate has cleared too, which lifted overall confidence from 40 to 62%. But a resolved binary and a friendly chart do not make a rich multiple cheap. The signal does not turn on timing here. The valuation ceiling is what binds. The honest move for a non-holder is to wait for a better price. For a holder, it is a hold, trimming only into strength toward the analyst consensus. Weigh the risk both ways, honestly. On the downside, an expensive multiple has the furthest to fall, a US drug pricing headline from most favored nation or Medicare negotiation, friction in the oral GLP-1 launch, or durable share loss to a rival could compress the multiple toward the 1,000 bear case, roughly 16% below here, near the 1,135 analyst low. Novo Nordisk's oral semaglutide is scaling, and a next-gen field from Amgen, Viking and Roche is forming behind both leaders. The stop sits at $1,105. But there is a second-order risk to a hold. The street still rates Lilly a buy with a median target of $1,350, so another blowout print could run without you. That is the trade-off. It is why this is a patient hold on a business worth owning, not a sell. Now weigh the risk against the reward. The bull case is roughly 26% above today, the base case the most likely, about 12%, and the bear case a fall of about 16%, so you are risking about 16 to make 26. So, our call on Eli Lilly on the New York Stock Exchange, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donation Investment at donation.ca. The link to the full report is in the notes below. Have a great day.